major implications for America and maybe even the world at some point. So the agenda for the morning is just going to be to get you in and out of here so everybody can get back to their important jobs. And we're just going to have a speaker set come up, talk about the background of the research. Then we're going to do a little bit of a presentation on the data findings, bring up a panel to discuss what that means. We'll close it out and get you guys out of here. I'll have the honor of introducing our first speaker of the day, Charles Fred, who is, I'll say he's the mastermind behind the TrueSpace concept. Charles is a very successful entrepreneur many times over and author. And when he exited his last company, I think he kind of looked around and said, what's my legacy going to be? What's the thing I'm going to do that really changes the world? And I think this project is it. He did a lot of extensive research into the contributing factors of job creation and where exactly we could focus in and build something meaningful to change that. And I think you'll hear from Charles his passion, but also the importance of that. And then we'll be able to share with you what we've built. So without
It's been 6 years for me to actually stand exactly where I want to be right now at this moment. As Joe spoke, I've been really lucky as an entrepreneur, and it truly is luck. Any of you that have gone through and built businesses understand all of the parallels that come with luck and hard work, but really at the end of the day, timing is probably just as important. And I've been lucky enough to build 3 businesses into the middle markets, and I've been lucky enough to find somebody that's dumb enough to buy them. So the last business that I had built, I sold to Xerox in 2011. And after we did a transition, I grabbed my brilliant daughter, Jamie, who's my co-founder of TrueSpace, and we got together and said, what do we want to do next? What's our next move? And my first job is that I had to convince my wife that I could do this again. So by show of hands, how many entrepreneurs in here are married or have a spouse? This is a big discussion, correct? So I've done this 3 times. I've been gone. I've been completely immersed and consumed by business building. And I said, I'm not going to start another business, but how about if I do some research? I think I'm going to start maybe with some research. So when Jamie and I got together and we looked at the businesses that we'd created, the thing that we tried to figure out is what was the value that was produced out of that business, other than profit, other than the things that we provided the healthcare industry for the last company we had. And what we looked at is the montages that we'd have at the year-end company parties, our year-end meetings that we'd had, and we got big enough where we literally had the most of a hotel. We had a screen the size of the one behind me, and when we'd get together with our people, we'd talk about the last year. And what we really saw were pictures, a montage of babies that were born, people that had graduated, people that had gotten married, people that had moved to our location. What we saw are lives. What we really saw were jobs, good jobs. We'd created some incredible jobs, and those jobs helped people build lives, build careers, to learn. And that's really what we said, that's the value of what we had. That's the thing that we got so connected to in the building of businesses. What is the end result? It's hopefully jobs for people's lives. And for those of you that have not had a job or had trouble finding one, if you want to help a human, help them find a way to be significant, help them find a way to contribute. So that was the essence of what we started. So that was step number 1. Step number 2 is, how do we do this? How do we go help businesses reach the middle market? And to our chagrin, the problem that we had is that there wasn't much research on businesses that are post-startup, because job creators are not startups. We need startups in this country. We are like consumed with startups in this country. But unless they get into the middle markets, they're really not big job creators. They're actually not great places to build a family. There's a lot of risk involved. There's a lot of things that you have to deal with from a variability perspective. So when we started looking, we found that there were 2.1 million businesses in the United States that had between 2 and 10 million in revenues. That's why we call the company TrueSpace. It's the space between 2 million and 10 million, which I'll talk about in a second. And these are post-startup companies. We use the term post-startup for a reason. They had customers. The average business that we were studying was 12 years old, not 2 years old. They had employees that had been there for multiple years, and they couldn't figure out how to grow. The first assertion that we make with our research is that building a business is a different endeavor than starting a business. And if you can come up with that assertion, if you can come to that conclusion today, what we're going to show you is going to be highly valuable. So we started with some naive ideas. And this was my naivete when we really decided on what we wanted to do as a business. Not sure this is working. It's not working. It's funny, can someone advance that for me? Naive idea number one is let's go study businesses and find out why basically they're not, thank you, why they're not growing, what's keeping them from growing. One of the things that I did when I sold my company to Xerox, I had this ability to get to Palo Alto Research Center and look at the science that we used at the Palo Alto Research Center for studying use cases for businesses, and it's called Ethnography. So I'm going to take you through a little bit of our study, our research, and why we came to this real quickly, and then I'll hand it over to Gallup to basically talk through the validation of this. So our first objective at TrueSpace was to find out what was keeping companies from growing. And that's the thing that we really decided we had to go spend some real time and some real money. So we chose 150 companies across this country to study, and we picked a study period of 4 years. That's why I'm in my 6th year today. 4 years seems like, oh, that's not that bad. But if you've ever done anything for 4 years with this intensity, you'll realize that we maybe overstepped our bounds a little bit. Ethnography is a form of anthropology. I get to study cause and effect in an organization. I get to look at decisions you might have made today and see the result of that 2 years from now, and we could study that. We did exit interviews on unplanned turnover with these employees. And the exit interviews would tell us all kinds of things. Now, unplanned turnover means you didn't fire them, they left. Those were your top employees. We gathered all kinds of information. We got to talk to customers. Customers that had purchased the services that you maybe have provided and those that chose not to. And we discovered all kinds of things in these companies. So the important part of really what this ethnographic research came to is we needed to look at these businesses in maybe a little bit different way. And that is this assertion as well. If many of you in here are entrepreneurs, do you like people coming and telling you how to run your business? There's a little bit of entrepreneur and parenthood that kind of correlate here a little bit. If I came in and said, you know, your business needs a little bit of help, maybe here's some advice, here's some counsel. We needed a science. We needed proof that we could go into a business that was stuck between 2 and 10 and help them understand what was going on in their business from a systematic perspective and give them the chance to make decisions on how to move it forward. So ethnography was the first thing. We gathered the data. The second science that we used is out of Jay Forrester's work, the late Jay Forrester from MIT, and he built a science called systems dynamics. Now, I'll apologize right now. I'm an engineer, and I've had to figure out how to describe what I'm going to tell you. But the 150 companies that we studied over 4 years bifurcated in the end of the second year. We had companies that were now approaching 10 million that we had started in the low to 2 to 3 million companies in revenue. And we had a whole cluster of companies that were stuck down at 2 million. If you read the report, we started on average 1.87 million in revenues of the 150 companies. And over 4 years, 133 of those companies had barely grown. They grew to about 2.4 million total on average. Now I want you to consider our study period just for a second. This was October of 2014 to November of 2018. Those weren't bad years to build a business. So why were those companies, the 133, getting stuck? We needed to find out, but more importantly, what were the 14 businesses that we called our benchmark doing to get past 10 million? And we found a pattern. We found a set of patterns. It became the essence of what we were doing. So how could we find those patterns? We started looking at these businesses as closed loops. A closed loop looks this way. The most common closed loop system with a human as the control mechanism is you as an operator of a vehicle, driver of a car. So let me describe a closed loop. We have stocks, which is where you store some level of value, and we have flows that change the value. The stock in an automobile, there's three of them. One is acceleration, one is navigation, and one is safety. So let me just take acceleration for a minute. Those of you that are driving a car, acceleration goes up or down. The stock value goes up or down. By using the accelerator, your brake, gravity, road conditions, all those things change the value of that. It's personified in a speedometer, but the speedometer is only the output device. You can see the stock is actually changing all the time. So we were able to study these businesses using that same technology, that same science. And we found 12 closed-loop systems that existed in the businesses that were reaching 10 million, that were non-existent in the businesses that were stuck. We found 12 closed-loop systems in businesses that were reaching over 10 million in the middle markets. And that's the essence of the research that we have. Now, for a narrative reason, we brought that back to 5 operating conditions. The 12 closed loops make up 5 operating conditions. And that's really where we got involved with Gallup. So we were able to take these closed loops and put it into a narration where we could actually look at, let's see, it's not going to the next one. There it is. All right, good. I do have maybe some training on how to use this at some point in time. So the 12 closed loops make up the 5 operating conditions, which is what we call the 5CA assessment. And Jonathan's going to come up and take you through this in just a second. But let me just briefly take you through the 5 operating conditions. These are the conditions that we measure in a company now with a predictive assessment that will help businesses get to 10 million and start creating more jobs. Condition number 1, most important condition we have, is alignment. And let me explain it real quickly. You have 3 finite resources in every business. Finite resources of time available, capital that you have to grow and manage your business, and talent. If those aren't lined up in a business that's stuck between 2 and 10 million, you will not grow. You're not growth capable. So our first question with alignment, are you capable of growing? Or have you diluted all those resources to a point where you can't grow? Because remember, building's different than starting. Number 2 is discipline. Can you scale the business? But we wanted to define this a little bit tighter because we think, based on our research, that scale is misunderstood as a concept in American businesses today. Can you build? The real thing here is, can you perform consistently time and time again? Can you wash, repeat, rinse every single day? Can you basically perform at the same level with your product or service each day? Third is a big discovery for us, and one of the things that ties out so nicely with the Gallup research, and that is predictability. We believe that the number 1 job of an entrepreneur, I want you to think about this for a minute, the number 1 job of an entrepreneur is to create the capability in your organization to become predictable. The 14 businesses that reached the benchmark had financing or forecasting predictability of plus or minus 5%. Is that a business you'd like to invest in? Absolutely. The 133 had average of minus 35%. Is that a business you want to invest in, want to work in? You've got to become predictable. Predictable became the fulcrum of what we're of really our operating conditions. The 4th condition was also a surprise. And remember, these aren't startups. The average business we had was 12 years old. If those of you that got started in a startup, it's a sprint. Or let's use a different metaphor. You're going on a hike. If you think it's only a couple miles, you're going to take a little knapsack. But if you have to go 400 miles, you're going to take a backpack. None of these companies had prepared for a longer journey, and their stakeholders weren't there either. The stakeholder expectation was so radically different in businesses that needed to reach the middle markets than startups. So endurance became this condition that has to be created. And then the last one that we have is the one that surprises us the most, and Jamie was the one that discovered this early on, is 90+% of the entrepreneurs that we were working with in this ethnographic study had no idea really what their company was worth, or more importantly, how to create the algorithms to find out what the enterprise value was. So imagine working 6-7 days a week, 10-hour days, working really hard, trying to grow your business, and you don't know if all that toil and work is actually creating enterprise value. So that's the fifth and most important condition. It's basically the outcome of the four. So with all that work, we got done, and we said, we really need help now. We've been studying 150 companies. We know these companies intimately. How do we validate this and put it into an assessment that we can bring to market and help? How can we help an entrepreneur figure out what he or she can do in their businesses? And back to luck. We got connected. We wanted, of course, we aspired to be in this room. And we got to know Joe and Dr. Rothwell and Sangeeta Badal, and the next thing we know, we're in a model creation process for validation. We wanted the science, the quantitative side of the science. And that's why I am thrilled to introduce Dr. Jonathan Rothwell, who is the genius, along with Dr. Sangeeta Badal, to help put the quantitative side of this. And that's a little bit of what we're here to talk about today, is how do we take this now from the study to the validation, now to the marketplace. So, Doctor.
Thanks very much. I'll take the clicker too. Thank you very much. Well, Charles, thanks very much for that. I'm going to describe the process that we went through to design the assessment and test its validity. So working closely with Charles, Sangeeta Badal and I were confronting essentially two major challenges in designing and validating this assessment. First was to quantify and translate the concepts that Charles's ethnographic research brought to the fore into a survey format that could be scored and compared across a large number of companies. And the second challenge is one that every assessment faces. We had to be able to predict something that mattered. And in this case, the goal was to predict financial performance. That means we needed questions that companies that were performing better on revenue, that were growing, that had more employees, were more apt to answer and more apt to provide what we would consider the right answer. So before launching the pilot to go into these ideas in more detail, we wrote out questionnaire, had extensive back and forth with Charles about getting the wording right and making sure we were capturing all of the stocks, flows, and conditions. And then we did a process called cognitive testing, where we'd take the concepts and we'd, especially for some of the items where there was some ambiguity and we weren't as sure about the wording, we'd test them out with executives in Charles's network to make sure that their understanding of the question and their explanation for why they would answer it a certain way was consistent with the intended meaning of the item. After making some changes, we felt confident that we were capturing the intended meaning, and then we launched the pilot initially with companies in Charles's network. So we had 51 executives take the initial pilot assessment, and then the questions became, were their scores valid? Did they predict anything that mattered in the real world? And fortunately, the answer was yes. Charles had his own internal rating of the companies, and as he described, there were 14 benchmark companies. So then the issue is, if Charles thought a company was benchmark, were they performing better on the assessment? And they were. And we identified that they really did stand out in terms of how they were answering the questions. And it also turned out that their performance on the assessment predicted employment and revenue. So we felt like we were making progress, and after some minor changes to the questionnaire, we had about 97 questions that we launched in a more expansive study with 2,500 companies that were not part of Charles' network. They were randomly chosen, more or less, using a combination of mostly the Gallup panel, which is a large pool of people who were randomly chosen to be contacted by Gallup in a previous survey and had identified themselves as a business owner. So that was the main sample, and then we supplemented it with a few other databases of companies. So this represented a quasi-random sample of entrepreneurs, and we found the same pattern. Again, high-scoring companies on the assessment were about 2.5 times more likely to be growing at 10% or more each year compared to low-scoring companies. We also ran econometric models to predict overall performance measured by revenue, employment, and growth. We found that the 5 conditions assessment score is strongly and significantly predictive of financial performance by itself, and holding other factors constant, like the age of the company, the industry of the company. What does that mean in practice? It means that an investor who knows a company's 5 conditions score can be much more confident about the financial performance of the company. Another way of putting it is that a standard deviation in 5 conditions score predicts a 0.41 standard deviation increase in performance, which is a very big effect. So next I'm going to go through each of the conditions and how they performed on the assessment. So we should have alignment next. We got predicted, there we go. So scores on the alignment items had the strongest overall correlation with performance and growth. To give one example, 69% of entrepreneurs in high-performing companies agreed that their company is a thought leader in its industry compared to 45% of those who are not high-performing companies. Alignment, more generally, as Charles was describing, gets to how focused the company's resources, its talent, its time, and its capital, how focused those resources are on the markets where the company can scale, and on the tasks that each person should be doing to raise the likelihood of success and sustainable growth. Other facets of the alignment conditions include a clear plan for major milestones, a distinctive and compelling point of view that is recognized by customers and competitors, and the recruitment and development of talented employees. Next is discipline. Discipline is about building the capacity for repeated high-level performance, for continual improvement, and it's in part by monitoring key systems and building resilience. Discipline entails things like the use of an employee handbook for governing disputes, the adoption of external oversight as by an independent board of directors, not just friends and family, and external auditing by professional experts. To give an example of how this played out at the flow level, companies with regularly scheduled performance reviews are much more likely to be high-performing businesses. Next is predictability. Predictability is an outcome of learning. Here the analogy with the scientific method is especially clear to me. Predictability involves the use of methods to measure and test ideas. For example, high-performing companies use customer relationship tools to gather systematic feedback from customers and learn from that feedback. High-performing companies also use financial data to set and communicate clear financial goals. As with good scientists, bring integrity and transparency to the disclosure of performance data and forecasts. The endurance condition speaks to how well a company promotes engagement and optimism in confronting the many challenges that arise over a company's life cycle. Some key areas include formalized compensation systems tied to performance, employee recognition, training, and social opportunities. The leadership, when it scores highly on the endurance condition, is viewed as pragmatic and capable by the staff and by investors. To give you an example, employee recognition programs and opportunities are much more common in high-performing businesses. And the last of the 5 conditions is value creation. It follows from the effective use of the other 4 operating conditions. Its key features involve the widespread understanding among leaders and stakeholders of the outcomes that create value for the company. The feedback loops from the other 4 conditions provide the data and information needed for a clear, big-picture overview of the company's value and assets. In short, value creation is what you might think of as the theory of the business. And just as in science, good theory depends on good data, transparency, and rigorous processes and procedures that build an understanding. And that's essentially what value creation gives a company. And then finally, before I turn it over to the next panel, we have a few examples of which of the survey items have the highest correlations with growth. They include elements of strategy for achieving milestones, developing talent, maintaining credibility, and developing a point of view associated with the company's brand. Just as good institutions at a national level, like accountable governance, bound by the rule of law, influence the growth and productivity of countries, the 5 conditions can be thought of as the institutions and operating conditions that companies need to maximize their probability of successful, sustained growth. We estimate that if just 10% of post-startup companies went from having a low 5 condition score to reaching the benchmark status, they would create an estimated 17 million jobs in the United States by growing to mid-market. What's more, as Charles emphasized, and which should be clear from the conditions themselves, these would be very good jobs. They'd be jobs that have generous benefit packages. They'd be jobs where the welfare of the employee is put at a high level. They're jobs where people are paid based on performance and feel like their compensation is fair. So the kinds of places that people would love to work for. I'm proud to have played a small part in helping Charles quantify and scale his ideas, and looking forward to hearing more from him and our other distinguished panelists, who I will now introduce. So if they would be so kind, we'll put the chairs up and then they can come up. I'm going to start by mentioning my colleague, who has been absolutely instrumental in this entire process and a delight to work with. That's Dr. Sangeeta Badal, who is a distinguished scientist at Gallup. Among her other achievements is she created what we call the Builder Profile 10, which measures the enduring personality traits associated with success as an entrepreneur. And we also are joined by the former administrator to U.S. Small Business Administration, Secretary Maria Contreras-Sweet. We also have Dr. Eric George, who is a renowned hand surgeon and serial entrepreneur. And we have Jennifer Meyer, the CEO of 1776, the prominent incubator with offices in DC and the Philadelphia area.
Thank you.
Okay, are we turned on here? All right. Thank you so much for coming out today. I know that one of the most precious commodities is our time, and for you to take this time to engage this group is very gracious of you and very generous. So thank you for that. Let me just first start off by saying thank you. This is an unbelievable body of work, and for me, having been the head of the U.S. Small Business Administration, if we had had this work a little bit ago, I think we would have even created even more jobs. But I don't want to make any political comments here today. But anyway, thank you so much again for coming out. Just so that we know who we're talking to, could we get a sense, please, if you are, raise your hand if you're from academia. Raise your hand. If you are from the Hill or anything to do with policymaking. If you are CEOs and business people. All right, that's the main body of work. And we'll, in the Q&A that we're going to have, generous of you to mention your daughter. And so I'm going to always mention the women that are involved. So thank you too for all of your contributions and for putting up with Dad.
Okay. God, you don't even want to go there. Yeah.
Okay, very good. Anyway, so what we're going to do is just first start by introducing ourselves. And so I know that you just did an enormous job telling us a little bit about how you thought about this work. But I'm really intrigued by your 3 businesses. I mean, you got to give us a little insight. What were the common threads that you found there? What were the anomalies? Could you just give us a little bit more insight into your entrepreneurial experience?
Yes, thank you. And humbly, so my last business that we created, which Jamie and I both worked in, was called the Breakaway Group, and we built online simulators to help doctors and nurses learn how to use health records and do it online and quickly. And we could validate that a physician knew how to use the health record workflow. That's the business Xerox acquired. Financial services, I built a business in financial services back in the late 90s when credit was, and credit scoring was such a global problem. And we built, at that time, a set of simulators for credit specialists. That company is now owned by Moody's. And then before that was really in what we would dub today the call center industry, but it was really the contact center industry and how you could take a massive workforce and reskill them from other industries like mining and others that were going out, and they could come up with new skills and find a way to make a living. So those were the three businesses. So
It's some of the three fundamental challenges that businesses encounter.
Yes.
So you're a problem solver.
yeah, so the small business thing for me is the pinnacle of our work, because the talent, we just make this grand assumption around talent. It's back to, you can start a business, but can you build one? And we need to be, I didn't know how to build a business. I had no idea. So how can we help? I'm not trying to judge, we're just trying to help you get a new set of skills to build. And that's really the essence of the 5-condition assessment, is it gives me a framework to understand my business so I can go work on it.
That's problem solvers. That's what entrepreneurs are, really. And Sanjita, I love your background. I mean, that you bring anthropology, that you bring all of these very different skill sets to your research. You know, allows you to look at it through a different prism. And so I really enjoyed reading your background. And of course, I've seen your articles in Washington Post, Huffington Post. So you're renowned and highly sought after. Tell us a little bit about how you came to this space. It's not a natural link to go from anthropology to entrepreneurship. So you're now the point person here at Gallup for entrepreneurship. So how do you make that link?
As a student of anthropology, I think one of the things that was really interesting to me was understanding how we can tackle the problem of poverty. How does that differ from culture to culture? Why do some countries make the leap of becoming developed while others continue to stay in the less developed realm? What are the factors that lead to that, and who are the people who are really leading or that growth? That led me to work with some organizations that in India, so my early years of education were all in India, where the entrepreneurship was a way for poverty reduction strategies and policies that the government was rolling out. Grameen Bank was just coming into its being at that time. And for those of you maybe not familiar with Grameen Bank, that's the organization evolved out of Bangladesh to give really small loans to these mostly women who were trying to make a livelihood by selling something really small, or maybe having a goat or a buffalo or a cow to get some kind of an enterprising energy going. So moving from there, in terms of the root causes of what leads some people to be left behind, and how do you provide them a life of dignity and a livelihood, to then coming over to do my PhD here, I continue to then study what is it that leads to that business growth. So that's my link to entrepreneurship. Now, of course, I'm talking about late 80s in India to now, where entrepreneurship is almost, or not almost, is the premier strategy for economic growth. From the poverty reduction piece to the center stage of growth policies, I think it's come along a long way. And then we have entrepreneurs and extremely genius people like Charles who are taking it a step further by putting a scientific base to it. My work in Gallup the last about a decade has been focused on understanding the human aspect that is critically important and usually the hardest to measure in what leads to entrepreneurial growth. And I think we have a long way to go. I call this the infancy of our work, and we are very fortunate to have worked with TrueSpace to not only help put a system in place to measure that economic growth, but also, or lead that economic growth, but also I think it has been a great learning experience for us in terms of our group that works here on focusing on the post-startup. As you know, majority of the efforts, which was the first thing that was very surprising to me when Joe put a team together and we started working on TrueSpace, is that we are so focused on starting a business that all our energies as a division within Gallup, we're also focused on how do you get people to start? How do you do early identification of talent? You put them through support systems, you put development in place, and then somehow that is going to impact how many of them end up starting businesses. Well, Charles opened this or brought this idea to the table of what about the ones that are post that stage, and what do you do there to help them continue to be sustainable?
We're going to get into that in a minute.
Yeah.
Okay. Wonderful. All right. Thank you. Thank you for that introduction. I really appreciate that. I'm going to jump over to Eric for a minute so that I can get back to you. I found your background to be really fascinating. I mean, a hand surgeon, and all the work that you have done all the way out to Kenya, everything that you're doing. And so how does a hand surgeon, again, the way that you approached your work, and then the way you thought, again, a scientific approach to entrepreneurship. Now you have this vast portfolio managing $1 billion of assets. Tell us about that. How did you make this connection?
Thank you.
Not all left brain people connect to the right side of their brain.
Thank you. Well, thanks for your kind words. I thought it was fascinating. You got an engineer here, and then you have an orthopedic and plastic surgery hand surgeon. So you've got to really mix at this table. And I will tell you, I'm from New Orleans, and when Charles asked me to come and look at the research, my life started off as an orthopedic specialist doing hand surgery, and then I branched into the world really as an entrepreneur, because we started developing hospitals and ambulatory surgery centers to allow for more efficient networks. Those then rolled into hospitality as an entrepreneur, and then ultimately those became pretty successful, and then I became an investor. So when Charles asked me to look at these, in the entrepreneur world, we employ about maybe 700 full-time employees, but in our investment world, the capital that we have tens of 20,000 of jobs. Right. And so I thought to myself, wow, I'd love to see this. Didn't know if he wanted me to look at it from the entrepreneur side or from the investor side. But when I reviewed it, I said, wow, this can really help me, because as an entrepreneur, which is one side that we're on, we ask these questions every day. How do we make the investor happy? What does he want to know? Then I put on the other hat as the investor, and I say, are these entrepreneurs telling us the truth? Are these entrepreneurs giving us the information we want? Right, guys?
Right.
So then you say to yourself, how could we benchmark this? And all of you, I saw many hands go up, as an entrepreneur, know that you say to yourself, what do these guys want to hear? What do they want to know? And there's no benchmark. It's, do you like the person in the company? Did you get a good name or a good reputation? And what they've done here today, and I know we'll talk more about it, is given us all some really good benchmarks to learn from an entrepreneur and also from an investor. I sit on a lot of boards, and they all ask these same questions. What are we looking for? Well, with this research, we're looking for, now I've learned, alignment, durability, the endurance. Those are great questions, and none of us have asked them. So I've been fascinated with the work, and I commend all of you, and I'm happy to be part of it. I have one last thing to say. I think Charles picked me because I have a lot of businesses that are stuck between $2 and $10 million, and I need some help.
That's beautiful. Thank you so much. And Jennifer, I had the great joy of visiting beautiful spaces throughout the world around, focused on entrepreneurship. But one of my favorites was yours, honestly. And not just because it was in my backyard, but because it truly did attract some of the most thoughtful and interesting people, and the dynamic that you created there. And so I'm fascinated by that place and what you've learned, how just give us a little bit about your background and how you got to the center.
Yeah, having physical places to convene has become a more and more digital economy is really important to us to be able to help entrepreneurs grow and scale their businesses. So we have 8 incubator locations across 5 states and are going to continue growth in the Northeast Corridor and outside of it. And really what we're focused on doing is bringing people together, providing them with the flexible workspace that they need, but really on top of that, it's the programming piece. This research is really important to us because we run an application-based process across all of our campuses, so we can curate and bring in growth-minded entrepreneurs. So we can use these benchmarks as part of our question process as we're talking to entrepreneurs through an interview process and an application process to make sure that they're going to be able to grow and scale their business. And then within that, we can also use it through the programming side. So we host a lot of panels like this at our locations. We have a mentor network that's really important, where we'll do matchmaking between companies that are in our spaces with particular mentors, and they are subject matter experts. They're in the service provider industry, so they're legal, accounting, HR, to really anything that these companies need in terms of resources to get their businesses to grow. And this is something that I'm excited to share with them too, because our mentors, I know, will be able to use this, and our program directors in each of our regions will use this as a way to build the programming that the entrepreneurs need. We do quarterly engagement sessions with all the companies in all of our locations to understand what their goals are, and it's part of our own internal tracking system. What we don't want to see is that we're talking to all the companies in Q1 and they're going through an early stage fundraising process. And then Q4, they're still in the early stage fundraising process.
So true.
Fundraising is a long time period, but we want to just make sure that we're using those engagement sessions to track what the growth is happening during those sessions, because we want to see them progress to, they've raised capital. Now, how are we helping them with growth marketing to be able to get their customers? What kind of talent are they bringing in now that they have customers and capital to be able to continue to grow their business? So we just want to make sure that they're on the right growth trajectory. And these are points that we can really use to put together other types of programs, make sure our mentors are using this. We're working with really more early stage companies, and that we're not a time-based program. It's not you've hit 2 years and we're throwing you out of our space. Nice. We want to make sure that you're growing. A lot of companies pivot during the time that they're with us too. And unfortunately, some of those companies fail as well. But we just want to make sure that they're riding along that growth trajectory. But we're seeing companies typically grow out of our spaces around the Series A mark, or when they're hitting probably about a 50-person head count is usually when we physically cannot house them anymore. But what we're seeing is that they're staying close by because they want to maintain a level of connectivity to the community that we've built, and also the programming. So we'll have companies that will literally take space in the same buildings that we're in, and leaving some of their employees with us, still using us for a distributed workforce across the few markets that we're in. But this is just really a way for us to be able to continue working with those companies that aren't physically within our spaces as well, to continue to push them on the growth trajectory to get them through that middle market stage.
Very nice. And my interest in entrepreneurship is that I was first asked to serve as California's Secretary of Transportation. And so we had 42,000 employees, a $14 billion annual budget that we had to push out every year. And the challenge was just getting those projects underway. And in that, I wanted to make sure that I did the counterintuitive, Charles, and debundled the work so I could get more local employment going and more job growth in the domestic USA versus the Japanese and the Spaniards and the Canadians and everybody else was showing up to build our bridges. And so what I found was that small businesses didn't know how to access capital, didn't know how to leverage and to build with us, grow along with us. And so when I left office, I started a bank, and then I had 2 private equity firms, and then I was asked to serve on the president's cabinet over small business and entrepreneurship. And so I'm just thrilled to be here, and again, just compliments to you and your family. Yeah. I wanted to ask you, because you've also authored books, and you have a very certain point of view, probably pre the research, and now you may have tilted a little bit in your view. So I'm trying to understand, because your frenetic, the frenetic world, and all your different books. Could you tell us about what was the most revealing piece of information? How did you view the world before, and now how do you see it after the research?
Yeah, the research changed us. I mean, for sure. I think all of us go into assumptions. We have this base set of beliefs that we have, and they're hard to get rid of. Some of these beliefs that we discovered are embedded in ways that really harm a small business. So I'll be specific. And it's many of it's out of the state you come from, mostly Silicon Valley. And it goes this way. Rapid growth is what we're looking for. Grow as fast as you possibly can, and we're all gonna get attracted to you. We're all gonna make a bunch of money. You're gonna get rich. So grow as fast as you possibly can. Raise a bunch of money, go throw this thing in the marketplace and see what happens. And the unfortunate part about that is that we started with that too, because rapid growth seems like it's great, right? Everybody's winning, but it's not a sustainable approach. And so this is where these companies got stuck, is that they went out and raised a bunch of money. They had big ideas, and none of it came to fruition. And now they're stuck there. They've given away half their company or more in fundraising processes. So I want to change that narrative. So that's one of the outcomes I'd love. Other really bad advice. Have a big, hairy, audacious goal. Go change the world with your business. That seems altruistic, it seems great, but if you can't bring some of those goals and plans back to a place where you can go complete them, it's like flying an airplane. You go from basically vector to vector. There are points where you get there. Believe it or not, that's how you get from point A to point B through that crazy sky we fly in. We need that for our businesses, not just to say, I'm going to change the world tomorrow and we're going to have this huge goal. And the third piece is structural. That this has been kind of prevalent all the way back to Drucker and others, because they studied big companies, not small companies, have a flat organization structure. The 14 companies that we saw in the benchmark from an anthropology perspective, knowingly or unknowingly created 3 core structures. They had 3 core responsibilities in the organization. So responsibility number 1, no matter if you were a product or a service or what kind of company you were, somebody was in charge of your value proposition and your product set. And they were sheltered to take care of that. The second person had complete authority over acquiring a customer, from top to bottom, lead generation all the way to the closing of the business. And the third, somebody was responsible for the customer satisfaction, the fulfillment. So what we saw in the slow-growing companies were flat organizations where an entrepreneur would have 15 to 20 people reporting to him or her. And that's the way you stop growing right off the bat, because all decisions come to one person. But they can find texts and advice and counsel from consultants to say, have a flat organization. So we discovered a lot of those things. And I think I came out of this maybe more enlightened, I would hope, definitely more pragmatic about getting to places. We believe today that you should be planning only a year out. I know that's heresy. Think about that from everything we've learned. Right. But when you plan further than a year out, and you have not been able to find a repeatable process, I can guarantee you with data that you won't hit your forecast. I have the data. So I'm trying to pull all those things back. Last but not least, on the 24-hour rule, we got to do those exit interviews. So the reason we're come up with monographs is that the other dirty secret we found is nobody really reads business books to their entirety. They read the first 30 pages. So let's write 30-page books from this point forward. So we found that most of the really top employees were leaving not because they weren't paid well. They didn't leave because they weren't somehow enriched in their business. They were stressed out. These were people that gave us lots of interesting language around they can't think straight, they can't sleep. They've taken stress home. And these are the employees that run behind us as entrepreneurs. We are the lead dog. We can't see behind us. So when we're sending out texts at 2 a.m. in the morning, when we're running at a pace of the persona pace of like Elon Musk, because that's who we want to be, we don't see what's happening to the organization behind us. And so the 24-hour rule was to be able to control the one thing we have complete control over, and that is how we respond and react to others as a leader. So it was just the data we had that said, you've got to find a way to pause. In this crazy, frenetic world, if you can't pause as a leader and understand that your reactions are causing massive stress in the organization, you won't be able to grow it. and it was an impediment to growth. So that's where that came from.
I'm just going to come right back to you real quick because one of the questions that I have is, do you think that there is one personality for the startup and then another person for the sustaining growth period?
I did before the research, and I don't now. I don't think it's personality, but I don't have a lot of data around that, and I like to stay pure to our data. A couple other things that we discovered. There were 2 turnover problems that we watched in the 4 to 5 years that we've studied now, the 6 years. Turnover problem number 1 is sales. So if you're struggling in sales, we are watching companies literally every 18 to 24 months turning over their VP of sales. Like, this person just can't sell, so we need a new person. Well, the cycle of that is the problem, if you use the 5 conditions, you don't have a sales problem, you actually have an alignment problem. It's not a sales problem, but you gotta go work on alignment. But they turn over sales, so back to this personality. The second was the CEO that just couldn't get this figured out. So we were watching companies in our anthropology base, ethnography, that were changing out CEOs with professional management. They would put in an MBA from somebody, or from somebody from the investment firm would come in and run it. And every single one of those in our database did not grow. Oh, wow. So we'd like basically to, and so that's my belief now, and I'd like to follow that up. We've got 3 more years with Gallup, so we're going to be doing a lot of follow-on research on that.
It's wonderful. Sanjeet, I have kind of a follow-on question to him, and that is, I see some women in the room, and women have a challenge. Let's be honest, okay? Let's just be really honest that we know that of venture capital, women are only accessing maybe 4, some people say 6%, even if I grant them 6%, that's still not, we have more than 6% of the ideas and pain points. And so how does gender, I know that you haven't, I didn't see it in the research at this stage, but did you get any sense about gender? Because I know that many of the women are very interested in that too.
Let me start by some of the research that Gallup has done, which is more seminal in terms of understanding if there is some difference in terms of the ability of women to be entrepreneurs. We now have studied over close to 1 million people, and we have found that there are actually no differences between men and women in terms of the inherent talent to be successful as an entrepreneur. Agreed. So when you start from that premise that, okay, we found in the data that there is no difference, then you look into the performance and you see that majority of the businesses, as you're rightly pointing out, owned by women, they start small in specific sectors that are not very profitable sectors, and then they stay small. So there is something external to the individual that is causing that. We haven't yet had the opportunity to do that with TrueSpace because our sample of entrepreneurs, actually I think we did look at it, but we need to have a bigger sample of women who are at the benchmark stage of business for us to really dig into what leads to the differences between men and women in terms of either their style or in terms of the systems that they put in place. But there definitely are structural constraints to why women-owned businesses lag behind that of men. And I think we need to figure out which ones, which we haven't dug into yet. But we will in the future to really understand what those are.
A follow-up question to that is with this advent of the B Corp, because millennials, I was just in a meeting in New York with some bankers and they were explaining to me how the millennial investor is not just asking about my return, but social impact, right? And so we see more B Corps starting up. Is there any difference in that?
So again, I think we do need data to say definitively that women are more socially inclined. I think there is an opinion or there is some anecdotal evidence that women are much more aware and connected to raising a family, to being closer to the environment, to be much more sustainable in their thinking, more long-term in their thinking, and all those qualities, if you would like to call them that, should have an impact in how they manage and grow their businesses or scale their businesses. We will need more information in terms of really parsing that out of whether that is specific to certain cultures, whether that is specific to a certain industry, size of the business, type of business, etc. But there is some literature that is beginning to talk about the social impact pieces and how gender roles can play a difference in how sustainable or how environmentally connected some businesses can be.
I'll just call you Dr. Eric. Sure. We all saw, everybody's been talking about the Larry Fink letter that came out, right? And the new, people are looking at the corporation quite differently, saying not just the bottom line, but also how we take care of our supply chain, our customers, our neighborhoods. It's a much broader concept. And with this advent of the global climate changes and challenges and everything, you see that every company I was looking for, that's why I was asking about the B Corp, companies are now thinking hard about their social impact in the community. The activists who are all asking us about ESG, the activist shareholders. And so I'm just curious because I see that you are a person who's been a successful entrepreneur, but you're always thinking about giving back as well. And so I was really impressed with that. The work that you're doing in Kenya, and it seems that at every turn you've always thought about giving back and having an impact. And so I'm just wondering how you think about this research in light of that. What's the link there?
Well, thank you. I think that this research really outlines that in that their messages through the 5 steps tell you that throughout your business, I have to tell you early on, before this research, I went straight for the rockets, the pre-startups, the startups. That sounded great to me. Go 0 to the sky and, 100 to 1 return on your investment. And the people that are stuck between that $2 and $10 million, the post-startup now has us all, me particularly, and all of our companies revisiting those people that are out there in that middle market. And in that the post-startup market. And in that group of people, it's about sustained growth. And I think as a community, it becomes almost a community for those people. They're there for the long haul. These are families that are connected. These are people who you care about. These are women having new children. And as Charles spoke about early on, he said, what did I remember? What did I like the most? The slideshow. Mm-hmm. So I think in that post-startup group, you're really a connected family, and you can then community feel like, let's help build a school in Kenya. As a group, all of us as a we, instead of just I'm the CEO and I'm going to make this a fortune and we're all going to get rich, I think that post-startup group says, no, okay, money is a great commodity of this. We all want to do well, no problem. But I think that long-term, sustained group of people are all together, and you'll see that group in our investments, those people that are in that $2 to $10 million range are the ones that are out there cleaning up the lakes. These are the ladies that are working in the soup kitchen tonight. That's that group. And I have some that are on the other end. And their focus is, what's my bonus? What's my salary? Mm-hmm. And the really small ones are, let's get in and get out. So I think this says a lot. And I think you'll see a lot more giving, a lot more compassion, a lot more interest in how to grow women, how to help minorities, because you're in the right group to do it. And that is that post-startup group, that 2 to 10, and we need to revisit those people. We really do, and I have to as well. I have one more comment to make. As I listened and read, everyone talks about the ones you've done well on, but as I read this, I kept wondering, did Charles and did Gallup look at some of the businesses that we did pretty badly in and said, well, this failed because we didn't have durability? Did this fail because we didn't have alignment? So it's been very educational for us too. So I think those criteria will get us back in that market, and we'll be able to give a lot more back.
Mm-hmm.
I agree.
Based on, Jennifer, what Dr. Eric just said, predictability was as I read it, was like the most connected to value creation. Yes. And so I'd be interested, because you're seeing them every day, right? Mm-hmm. You are, and you're seeing them go through their raise and everything else. So I'm just curious to understand then, Are you able to say, because that's what the stock market wants to know, right? That's the guidance, and they want predictability. And even sometimes when you're more successful than anticipated, you weren't predictable. You didn't meet your range, and so there's still a reaction to that. So I'd be curious to see what you observe and how you think about the predictably condition here in this report.
Yeah, I think it's really important to look at them across the range. And the one that I actually found was most applicable to the companies that we work with was actually on the discipline side, because it tends to fall in the category of things that first-time founders don't want to deal with. It's the stuff. It's the legal things, the accounting things, the HR things. It's not necessarily fun to put together all your KPIs for your company.
Okay.
That's not what they want to do. They want to have a whiteboard session and think about how they're going to go get their next customer and how they're going to look at the scale side. But there's this whole fundamental piece, and I really want to emphasize the most we see this is with first-time founders, because serial entrepreneurs know that this is a really big part of it. And that really lays into the predictability piece. It's really building blocks. So you have to do the stuff that you don't want to do. We talk to people all the time that you're not going to go get capital if you don't have the right legal docs in place. You have to start with that as a fundamental base. You have to build the right culture within your company, and you have to have the right KPIs. We'll talk to founders where they've only done a family and friends round, and I'll say, I don't care if it's your mom and your uncle and Billy from down the street, you need to have a board meeting with them. Get into the rhythm of what that's like. So when you have a group of independent board members, you are used to that quarterly board meeting and preparing yourself for that and making sure that your financials are on track, and then running through the KPIs so that when there's 4 of you on the team and you're having those really fun whiteboard sessions, each one of those people has KPIs. So as you're bringing somebody else into the company, if you're not the person, because you shouldn't be, to your point, of building the KPIs for every single person in the entire organization, that it's become a really part of your culture that flows down. Once that fundamental piece is there, that's when you go into, for me, the way we work with our startups, that's when you go into all these other pieces, when you're working on the predictability side and really focusing on the scale, which I define very differently than growth. Scale is going like this, growth is kind of this very incremental piece to it. And that's when you're actually going to be able to achieve a lot of those other pieces. And I'm biased because I was an attorney, so I have the background on seeing what happens for companies that don't have the legal pieces set up. They get into co-founder issues and they didn't have the right documentation, and it leads to a disaster. You don't have the right buyout provisions in your documents, and investors are going to look for them. Your customers aren't, but your customer contracts can become equally important. Having the right HR processes in place, and the accounting piece is hugely fundamental to be able to achieve the scale. That you have the systems and processes in place across the board. So then that's just turned on and kind of running in a sense of autopilot in the background. So you can focus on the fun things as a first-time founder, focus on really building your business in a predictable way that you can get the scale and not just growth.
Very nice. Sanjita, you were going to say something to add to that.
I think I was thinking about the gender differences in success for women-owned businesses. And one of the things that we did look at is if there is a difference in terms of the performance on the assessment that we've built here, and we don't see any age, race, or gender differences, which tells us that this assessment does have the ability to really predict performance or success irrespective of any of those other biases that can creep up. So when investors are looking at businesses, usually and we've not only heard stories about this, but have been written out in articles of if a man goes into asking for capital, the success rate of getting that capital is much higher than if a woman-owned business goes in to ask for capital. And I think one of the positives of this assessment or this methodology to assess businesses is that you can put them all on one plane to then take away that bias that people have had against traditionally those groups that have been disadvantaged in this whole entrepreneurial ecosystem.
In that regard, following up on that, Sanjita, we've all heard the data point, right? 95% of the world's consumers are outside of the U.S. I don't know how many times I've heard that statement. So I know that that your work at this point was largely domestic oriented, but understanding that and understanding the external challenges. For example, right now we have the coronavirus, things that you can't anticipate, but you want to access those markets. How do you think about the next phase of research, and would you be thinking about that? And what would be the questions that you'd want to understand?
I think we have a very robust agenda. We want to, right now, what we've been able to establish is correlations between the systems and processes that we are measuring through the 5-condition assessment and the outcomes, the business outcomes. But that's just step one in the process of really figuring out what leads to success. I think our second major goal is this what the system and processes that we study and measure, does that really predict performance, and how accurately does that predict performance? And that is something that will come with time. And so we want to now set up predictive studies to see whether measurement of the systems and processes in time 1 really predicts performance in time 2. We also want to dig into, like I said before, into the gender issues of, is there a difference between how women-owned or men-owned businesses are run? Is there a difference in terms of, we are also putting a study in place where we are seeing the team configuration. So a lot of our studies so far with Charles has been based on understanding the ins and outs of the business through the eyes or the lens of the one individual who's the CEO or the chief executive of that company. Going forward, we want to see what is the team dynamic in that business and how does that impact performance? Does diversity make a difference? Should it be neurodiversity, gender diversity, racial diversity? Do all these, or even experiential diversity, do all these kinds of differences in the executive teams make a difference in terms of how the businesses perform? I think that's a really important question for us. We also will, going back to the closed loop system that Charles has developed, we want to make sure that we have a problem that we are solving, the action we take, the results we get. And then from the results, I think there are new questions that will emerge that would lead us to the next phase of the research. And so that scientific process will be ongoing for the next 3 years.
Very nice. I just, Charles, you went from 3 entirely different businesses. And so I'm really fascinated by, somebody who can pivot that much. That was really, so again, I know I keep talking about the personality, and Sangeeta's assured us that it's not the personality, but culture, right, does play a role. The culture, I mean, I'm not, this is not a smoosh, it's my Spanish, every once in a while it gets in the way of certain words. But what I wanted to say is, I could just feel the effusive goodness coming out of you, even as you opened up the word, and, you're somebody that people want to, I imagine they want to work for you, and there are other personalities that are not as, as endearing. So I do think that has something to do with it. Could you talk about your personal experience in that regard?
Yeah, so on that front, we saw quickly in our ethnographic work the connection between having a sense of belonging in an organization and not. A job versus really something I'm really passionate about, and their ability to endure that. So I think we can get people to work for money for a short period of time. Mm-hmm. And this is the problem we've had in startups, is that they're sexy, they're fun. We have kind of Jamie and I, we compare, you go to a neighborhood cocktail party, and the poor soul that has a small business versus maybe the executive at some big company. Oh, what do you do? Well, I have a small business, and they just move on to the next person. Or I'm in a startup. Oh, tell me about the startup. It's so cool. So I think when we talk about endurance, we talk about it in our flow. You have to have credibility with the leader, which, by the way, is a tight correlation to long-term performance. You have to have a community that you're part of, and you have to have durability. So those are all somewhat leader-led in some way, shape, or form. Mm-hmm. I also believe, though, we did a lot of work early on with Jim Collins to try to understand a little bit. He's a neighbor of ours up in Colorado, and he talks about the charisma is not a reason people stay, and we validated that. You can't just be cool in the moment. It's all about authenticity of a business. Right. That's where you get people to work with you. And by the way, I'm as flawed as they come. I mean, part of that book you talked about is I've kept a daily journal since March 27th of 1985.
Wow.
Why do I do that? Because I doubt myself so much every single day. And so I have flaws like crazy, but so people give me a pass. I think if we can get them connected to a reasonable piece of work, we're doing something that's not polluting the earth, we're doing something remarkable. It's amazing what you can draw together from that versus let's get rich. I've got this great idea, I'm going to get 1 million eyeballs on some click, and we're all going to get rich. It's really hard to stay with those kind of companies. So I hope I answered your question, but I think there is a need for people to develop businesses that have real purpose.
Right.
And it doesn't have to be fancy. Some of the best businesses we've seen are really boring businesses.
Right.
And yet they're great places to work.
Right.
And the people there are really authentic. So.
Because, the reason I asked that is in California, I helped to created the Department of Managed Healthcare, the regulator for HMOs. We had the deepest penetration. And so in creating that department, I was, just doing research because, of course, the attorneys wanted to be able to sue and doctors didn't, wanted to mitigate litigation. And so we had this conversation. And what we found is that bedside manners made a huge difference on whether there was malpractice lawsuit, that ensued, right? And so we find that and that's just not in that business, it's in every sector. If you like your doctor, if you like the person that treated you, but they didn't serve you the right coffee, you kind of say, I know they're having, you move on. Yeah. But when you don't like the personality, and so I'm just, I asked that question because I appreciate very much the predictability, the discipline, everything that we talked about. But at the end of the day, somehow there has to be an element about personality and culture and the human element in it.
For sure, yeah. The entire thing is human element. If I can just finish on this, we have 30 things that we measure. They're called flows in our assessment. 97 elements get to 30 flows, get to 12 stocks, and get to 5 conditions. I just love that stuff.
He's an engineer, remember
you
that?
You can tell that.
And they're way, anyway. So one thing that we didn't have in our flow is culture. And I need to explain that because some people might say, because I really believe culture is such a strong component. I think all 30 components measure culture. I think culture is possibly the composite. Because you can't be robotic. You've seen this. You can't just say, let's go measure everything in discipline. And you're like, oh, that was fun, wasn't it? It's got to have relevance and context and meaning and all those things. So we think culture is actually a summation of all of those 30 things. Back to your point, and probably personality definitely fits into that.
That's fair. Very nice. Thank you very much. I'm going to do something that we hadn't planned, but that's the moderator's prerogative. But we don't have that much time left before we get into the Q&A. And we are in Washington, D.C., and so I thought we'd just have for a second a policy hackathon. Okay, so if you could hack one policy, if there was a message here and you had Disciples of Change here, which you have, and there was one policy that you thought that, like if they did this, it would really help entrepreneurship. I'm just curious to know, maybe starting with Jennifer, because she's dealing with so many different businesses, and I know that having overseen the SBIC program, the SBIR program that we engage with your center, you're probably really in tune with some of the things that SBA and Commerce and some of the other departments are doing and aren't doing. Could you lead us off in this hackathon here?
Yeah, we've, across the different states in the District of Columbia that we're in, we've seen a number of different government programs that really help our entrepreneurs. Most recently, it's really been an explosion around the SBIR programs. And we've seen a number of different tax credit programs and grant programs. Particularly with SBIRs, what we've seen is getting matching funds for many of the local communities or the state governments has been really impactful, and it's actually been a way for us to drive businesses to our locations, to headquarters within those states. So in an area like this, where we have Virginia, Washington, D.C., and Maryland, Virginia has some 10% matching programs, Maryland has some 25% matching programs. That's a pretty significant difference in capital when you're looking at that as a matching to an SBIR grant. The state of New Jersey has a program called the New Jersey Ignite program, where as an incubator you can apply to get accepted into the program. There's only 12 incubators in the state that are accepted, and the state actually pays the membership fees of the companies to be in the incubator space. The requirements are pretty simple: early stage, less than 3 years, less than $1 million. in revenue, less than 10 people in the company. It's a really small budget line item for the state, but it's hugely impactful for those companies because it just washes out an expense. So we've been looking a lot on the economic development side. We started tracking not just capital raised by our companies, but job creation that comes out of that, which has the ripple effect of then, creating taxpayers in those communities. So we've started to work with a lot more of the economic development agencies, and it really comes down to either on the tax credit or grant side for those early stage businesses, or the capital coming in on a matching program of an SBIR, or even if there was an SBA loan or something like that. And we started our business with 2 SBA loans, so I'm biased to the SBA
All right, very good.
program.
I like to hear that.
Right,
I was at a reception recently, and Kevin Plank approached me and gave me a nice warm greeting, and he said that he had gone to, here in Baltimore, he had gone to so many financial institutions that wouldn't help him out. They didn't believe in technology in clothing, and then came to the SBA, and we guaranteed his loan, of course, through a financial institution, and Under Armour. But there are stories over and over and over. So for those of you who are not familiar with the US SBA, the fundamental program is a loan guarantee program, so that when you go to the financial institution and you don't qualify, or they're about to reject you, you can ask them to run you through the SBA prism, and we guarantee 2/3 of that loan. So for any reason there is a default, Uncle Sam, you have an Uncle Sam, guarantees 2/3. So it helps the bank get over the finish line in cases of disaster. But I find the programs that you referred to, the SBIR and the SBIC, for this size of business, to me is really fascinating. And that is that the same thing, that if you want to start a fund to invest in businesses, it's the same thing. Say hypothetically that you raise $50 million, SBA would match, that would guarantee from a bank, a financial institution that SBA has a relationship with, they would guarantee another 100, so it's a 2-to-1 match, so you have a $100 million fund, and it's non-dilutive, so it's really fantastic. And then, of course, the SBIR is fantastic, which is basically grant money for research, so that if you're going to help create respond to something that the government needs in cybersecurity, DARPA, education, health, any of those fields, SBIR are essentially grants to help you, and they're meaningful grants. They're very meaningful. And I would really like to see more diversity in those. There were times where year after year I saw the same guy coming back in and getting another SBIR grant, and I said, no, we were supposed to start you up, and then you're supposed to get going and not come back for another startup. That's not the program. So anyway, but they are fascinating programs, so thank you for that. Oh, okay, so we're gonna end on time. Okay, all right, very good. Well, that was really good. Did you just have a real quick?
So another policy change that I think we should make is, we found in our research that it's not the first gen immigrants who start businesses as much as the general belief is out there. It's the second gen entrepreneurs who end up starting successful businesses. I think one of the reasons is that the first gen is still establishing their roots here, and it takes so long to go through the immigration system. One of the things I think we should help our policy makers understand is that for those who show the building capacity or have started building something, the green card process for them should be really sped up, and so that they can become part of this ecosystem where then those facilities like the SBIR, et cetera, open up for them, and they should have an easier and a smoother path to be in this country permanently.
Thank you, very good. All right, we're gonna open it up then. We started 15 minutes late. I was gonna go 15 minutes over, but I'll respect the time. You gentlemen in the back. Oh, okay, you go ahead. Go ahead, you've got the mic, go ahead then. We'll go back to you, right?
Thank you for the great panel. My name is Roy, and I'm an entrepreneur. I started a digital agency about 3 years ago. So we help companies with content creation, advertising. So what I found fascinating is 2 points, Sangeeta's point on the immigration. It took me 13 years to become an American citizen, and now I can start a business. But I love this country, no matter what, because I went through the legal process. And the second point is, I had a question about, is there a difference between scaling a product business versus a service business? We're in the service business, and we're in a growth mode. And I just find it, I mean, maybe looking on the grass is always green on the other side, thinking if it's a product business, it's easier to get customer because it's the same product. Is it the same way? Am I in my own head? That would be great to have insight on this.
You want to take it, Charles?
You're in your own head. Which is, by the way, the fact that you're asking the question just makes me happy, because you're asking the right question. We got to start asking these kind of questions. Scaling isn't determined by product or service, and we got to see that with real data. Scaling really is the 5 conditions. So making certain in your firm that you have tight alignment between, especially in a service firm, between your value proposition, which is your promise that you're making to the marketplace, in a market where you can win a huge percentage of your proposals. Tighten up your market as tight as you possibly can. Make it hurt almost to walk away from deals, and you'll start building. Scaling a service business and a product business means you have to start and repeat. And you can repeat a service business the same way you can repeat a product business, sometimes easier. One of the things that we studied were consulting companies that would say to Jamie and I, our value proposition is customization. We're creatives. I can't do this repetition thing. And we said, great, that's a great value proposition. What's the basis by which you're becoming creative? What's the basis by which you're customizing? That's what you can replicate, and that's how really good service businesses build. So you're asking the right business, but don't give yourself a pass because you think products is easier. I actually think it could be at times more difficult. Because, and are you a business-to-business sale or business-to-consumer?
Both.
Okay.
Associations to help them bring thought leadership, but also we can help them like mid-sized small business to get more customers to add.
Great.
Maybe like the idea is just focus on one and
Yes. We call them high-value customers. If you're scaling a business, you figured out who your high-value customer is. And every other customer, by the way, is the low-value customer. So a high-value customer knows that you're the thought leader. They pay your price. They love your people. They like to be affiliated with you. And they'll stay with you because they're pragmatists. Everybody else does just the opposite. So find those high-value customers.
Very good. There was a gentleman here who had raised his hand. Go ahead.
Thanks, Jack Stern. I'm the co-founder of Luminant. We're an energy efficiency company. We're right in your target range. We had $600,000 in revenue in 2017. We'll probably do close to $10 million this year.
Nice.
So
Good job.
my
Congratulations.
question is that we're an LLC, just converted to S Corp. My business partner and I bootstrapped this thing. We own 100% of it, 50-50. How do we create accountability between the two of us? Because we're not going to have a board, right? So to me, I think we're doing a lot of the things.
I think even if you're not going to have a board, having some outside piece to hold you accountable, because just doing it within each other isn't necessarily going to work. So even having a formal advisors where you're not beholden to everything they say, like a board of directors, and you don't have an operating agreement that's putting certain powers and authority with them and certain powers and authority with you, but having some regular cadence of, because you're not beholden to investors either, having some cadence of subject matter experts in your area that can serve as formal advisors. And we see a lot of them that won't take equity for those positions and just they're serial entrepreneurs and want to see you succeed. But being able to have some level of outside accountability, I think, would be the way to do that.
We do have a finance partner.
Good.
Yeah, so that's helpful.
There you go. And remind
Congratulations.
each other too of your value, the values that you share, right? Because then that brings out, which is obvious, the integrity element, and that helps sort of put a little pressure on each other too.
Yeah, that's great.
Very good. Yes, sir.
Thank you. Michael Butera. I'm with Association Activision. It's a consulting firm that works primarily with not-for-profit tax-exempt organizations, associations, and like, which are businesses too.
Yes.
So I'm wondering if in the research there were a group of not-for-profits or tax-exempt businesses involved, and if you found any interesting differences between the for-profit and the not-for-profit sector. A. B. If you didn't, I'm wondering about whether, this is a terrible thing to ask researchers, whether or not you would like to speculate on the value of the research for the not-for-profit community. Thank you.
Sanjita?
That's you.
I think the systems and processes that are measured through the 5-condition assessment would be the same across the profit and non-profit system, because even if you are in a non-profit sector, you still are creating value. You still are serving customers. You still want to stay sustainable, and you want to be alive. So a lot of the things that we are talking about here, especially in our research that we are looking at, absolutely, in my opinion, should be applicable to the nonprofit sector. And if there are nonprofits who do not think that some of these things are relevant, then I think they need to maybe change a little bit in terms of the mindset of how they perceive a nonprofit should function versus a for-profit business. So that probably would be what we would recommend, looking at the conditions that we've studied, looking at the data that we've studied. We don't think that we had a large enough sample of nonprofits in this 2,500 sample that we studied, because we were actually going for businesses that were revenue generating businesses of specific size, age of business, and also we had a industry spread. So I think it's a really good question that we can look into by maybe having a research project focused on the nonprofits. But in terms of the content of what we are trying to institute into the businesses, it should be the same.
Yes, ma'am. I can't see, or is it? I can't see. Oh. Sorry.
Hi, my name is Ashwat, and I'm a student at GW, and I'm also the co-founder of Culture Media. We are a creative agency that focuses on connecting social impact organizations with young people in a more effective manner. So my question is mainly, do you think entrepreneurs should be building up these processes to meet the 5 conditions while they're starting, and what advice do you have on how they should be doing that?
I'm going to go to you, Eric.
Well, I think that's an absolutely great question, and I have been, as you heard, in the post-startup phase, ones that have reached mid-market, ones that have moved beyond. I think unequivocally you should. I think that I'm 58 years old and been doing this 30 years, and there was no benchmarks like this ever. It was all a feel thing. It was all a judgment thing. It was a quality of the woman or the man that was doing it. I heard all these comments about where they're from. Is he from Mountain View, California, and is it tech? Well, then we should put money in it. And if it's healthcare and they're from a small town, maybe not. And that's just crazy. And we all did that. We've all been part of that. And I think this tool that TrueSpace has created for you is fantastic. And looking back, if I were starting one today, my answer to you is simple and absolutely. I would reach out to these people, look at those benchmarks, and I think anytime you know anything, as a surgeon, we learn very early on that any bit of information that you can get early before the problem arises and have all those things in place gives you a much better surgical outcome. And you don't want to come back and say, wow, I wish I would have known this CT or this MRI or this X-ray. You've got the greatest advantage in the world now. You're young, you're starting a new business, and you have this TrueSpace tool perfect for you. And I would look at those 5 criteria. I don't know how they're going to play this out. That's more for Jamie to answer, but I think that they could help you, start you, educate you, and then use these benchmarks every quarter or however you envision doing it. But I think it would be perfect for you. I really do.
I just want to add that we're all tracking AI, right? It's if you're not engaged in AI, you become a dinosaur, as they say. And so I see it the same way. With AI, if you have to start with really good, clean information because you're building off of that. So if you start with bad information, you're building off of bad, then your entire investment is for naught. So it's the same way in building a business. You have to start with the sound foundation to build upon. An engineer would tell you that. So I think that's exactly right. You're getting really good advice here, and I know you will heed it, and thank you for being here. Let me just say, because we're in the month of February, that I'm thinking of Dr. Martin Luther King. And you remember Dr. Martin Luther King said to us that he fought for civil rights, and he wanted to make sure that everybody had access to the diner, right? Remember the counter. And so we say here that what good is it to be able to sit at a counter if you can't afford to buy the hamburger? And that's what this is about, is being able to build economic growth, to job creation, capital formation, and enterprise. And I want to tell you that having had the privilege, the absolute joy to be able to represent the United States of America, myself, I was born in Guadalajara, Jalisco, Mexico. I got here at the age of 5 and I couldn't speak one word of English, and that's why I still get tongue-tied on my Spanish. But you know, I remember when we left and my mother was saying that we were going to America because there was such bounty here. And I remember tugging at my grandmother's skirt and I kept saying, Grandma, Abuelita, I don't know why we're leaving. I love my school, I love my church, I love my home. And she said, because you're gonna do good and you're gonna prosper there. And she said, and you know, she says, although we've always been migrant workers, I have a feeling that someday you're gonna be able to work in an office and then you're gonna be able to be a secretary.
I love that.
So the good Lord, through small businesses and growing businesses, allowed me to get a job, to pay my way through school, to eventually start a bank and 2 private equity firms and become a cabinet secretary, to hold office and to be that secretary my grandmother envisioned. But that is the beauty of America. That is the beauty of being able to go from one sector, one class, and up the mobility that we have, the social mobility. That's what is America to me. And when I go to other countries, they just don't have the capacity that we have. I can tell you stories from being in Estonia when people said, you know, we count on America to protect us. You know, in Cuba, when the people, the entrepreneurs said, I can't have more than 50 chairs in my restaurant or I'm fined. You know, in Kenya, when they didn't have a financial system, and some guy came up and invented M-Pesa, which would replace in almost like a bartering system through their mobile cell phone. The innovation that's taking place, but they all marveled and looked to America for leadership. And so with your leadership, with your generosity, and with all of your good work, I know that we can continue to be that wonderful, exceptionalist country that we all know that we are. God bless you and God bless America. Thank you so much for joining us today. Thank you.
Thank you very much. That concludes the panel. We're about 10 minutes over time, so I'll make this really fast. First, I just want to say thank you to every single one of you for being here and sharing your thoughts on this research. It means a lot to us and has given us a lot to think about. Thank you to everybody in the room for taking time out of your busy schedules to be here with us. It's a testament to your opinion that this is an important subject. I want to say a quick thank you to Charles Fred and Jamie Fred. You guys have been awesome to work with. You're brilliant, and you live your values, because one thing we noticed early on is that you are aligned and focused on a very specific subject, which is this post-startup, and you've put your capital, your talent, and your time exactly on that for, 6 years, and it's amazing. You can actually see the value that's created in this work, so thank you for that. Quick thank you to the Gallup team. When I said I met Charles and Jamie, they shared this idea. It's unbelievable. We have to be a part of it. This is going to be groundbreaking. They kind of stared at me, but I think as we started to dive in, just the immersion of learning and heart and soul that we put into it and that you put into it has been amazing to watch, and I think we've got a great partnership. This work will make a difference. You can already hear some of the comments about how if it changes the way investors think, if it changes the way entrepreneurs think, and we start to have any measurable change at all in this, it's going to be enormous for America. So thank you, and make sure you grab a report on the way out and keep the conversation going. This officially concludes our program.
Great, thank you.
Thank you.